Index Fund versus ETF, explained. Welcome to this video where we will discuss the differences between index funds and ETFs with the help of a simple metaphor. Whether you are a beginner or an experienced investor, these investment vehicles can often be confusing. So, let's make things simpler. To understand the differences between index funds and ETFs, we will use the metaphor of a grocery store. Imagine you are in a grocery store and you come across two products, a bag of apples and a fruit salad cup. Both of them contain apples, but they are packaged differently and have some distinct characteristics. Index fund. Now, let's relate this metaphor to investing. An index fund is like a bag of apples. It is a type of mutual fund that aims to track the performance of a particular stock market index, such as the S&P 500. Just like a bag of apples contains many apples, an index fund contains many stocks that are part of the index it tracks. The objective of an index fund is to provide investors with the same returns as the index it follows. ETF. On the other hand, an ETF, exchange-traded fund, is like a fruit salad cup. It is also a type of fund that tracks an index, but it is traded like a stock on an exchange. This means that you can buy and sell shares of an ETF throughout the trading day, whereas index funds are priced and traded only once per day. Additionally, ETFs can track a wide variety of indexes, including stocks, bonds, and commodities. Comparison. So, the primary difference between index funds and ETFs is how they are traded. Index funds are bought and sold at the end of the trading day, while ETFs can be bought and sold throughout the day. Additionally, ETFs can track a wider range of indexes than index funds. Which one to choose? Now, the question arises, which one is better? Both index funds and ETFs have their pros and cons, and it depends on your personal preferences and investment goals. Index funds have lower expenses and are ideal for long-term investors who want a simple and diversified investment. On the other hand, ETFs offer more flexibility in trading and can be an excellent option for active traders. Let us elaborate on the examples mentioned earlier in the metaphor. For instance, when you buy a bag of apples, you know what you're getting: apples. You do not have to worry about the types of apples, the number of apples in the bag, or their individual quality. Similarly, when you invest in an index fund, you are investing in a collection of stocks that replicate the composition of the index it tracks. You do not have to worry about the individual stocks or their performance. On the other hand, a fruit salad cup contains various fruits, and you can see what you are getting. Similarly, when you invest in an ETF, you can track multiple indexes and trade them throughout the day. You can choose from a wide range of options that align with your investment goals. Conclusion. To summarize, index funds and ETFs are both excellent investment options that can help you achieve your financial goals. Understanding their differences will help you make an informed decision on which one is right for you. Remember, an index fund is like a bag of apples, while an ETF is like a fruit salad cup. Thank you for watching.